Whenever I say production problem or something like that, that is code for the. I don't know what I'm doing. Okay, so let's just pick up where we started here. This is part two. We dropped off at the part where we're talking about global interest rates. You can see here on the screen, which is that look, we've got higher rates around the planet. And so now it's not only that the United States has higher rates as a result of inflation, but in addition to that, if you continue to have problems, what happens in these other countries, and you can see what I'm saying by Germany and Japan here, this is why I'm showing you other alternatives. So now you're oil fund of Norway. You're looking around the planet and you're going, yeah, I've got to switch dollar into euro and take this risk and then swap it back into my home country. Forget it. I can just get German bonds at this rate over here. Well, then the question becomes okay, well, if that's the case, now that they're not a buyer of US bonds. So guess what? Less buyers means more sellers dominating buyers, meaning lower prices, higher rates. Same difference. And so now this is what's going on. And this is the reason that the Wall Street Journal has correctly pointed out the fact that this is a global matter. Now, when we come down to it, the issue then becomes now back to the United States when we're talking about equity markets. Now you can see now why I'm saying have bet on stocks for show, bonds for dough. Because now that has meant that this R here is higher. And when R is higher, now around and around we go. Mr. and Mrs. Jones in Kansas. Money's in the 401k. That sits in a TDF, which is targeted date fund, which sits at the majority of Fortune 500 companies as the default position. What do? They're looking at around at these differences as well. And what do they see? They see this and they go, why do I own stocks here given the fact that where is this? The equity risk premium, which is this difference here. And this basically to review, right? In other words, if I can get the same type of return in the bond market compared to the equity market, why am I taking the extra risk of stocks? Right? In other words, no matter what, if we have Jay's Rib Shack or Apple Computer, doesn't matter, right? The bond is safer than the stock. And the reason is that if Jay's Rib Shack goes belly up, have to pay the bond owners first. So it's inherent nature in your list of debts at Jay's Rib Shack pays bond owners first. So as a result, you can see you need to be paid for taking the extra risk. Now I have discussed this, and now you can see why this is like kind of crazy that I have all these topics tied in together. And you can see it here. I called it, this is the equity risk premium. For those people who have watched videos, I have used the phrase from Heat, is the juice worth the squeeze? Meaning that is the extra risk of equity worth it? And now around and around the comparison goes. This is why interest rates have to be first. What does stuff cost? Okay, well, Jay's Rib Shack, right? He's got to pay bills. He's borrowed from the bank. The cost is higher. Jay's Rib Shack's profits lower. As opposed to Apple Computer, hey, we've got tons of cash, number one. And number two, we borrowed a long time ago when interest rates were way lower. Why? Because we've got a team full of Jays in here watching and scouring the globe and borrowing at the cheapest rate around the planet. Of course they are. Absolutely. And this is what the Treasury Department CFOs are considering all the time. And so now they're raising capital for their own uses at the lowest possible rates. Why? To increase profits, optimize profits, as they should do, as they are paid to do. The point here is because we have this thing round and around. Now we've got turmoil, or turmoil is probably too strong. A very unsettled equity market, 4% down year to date. The number that I shared with you, earlier today in part one. There we go, in part one. So that is not all bad. Okay, and I'm going to close this with the next segment, which is that while your equity may be more volatile, right? So more volatile. I didn't say deterministically. I did not making predictions of up or down. What I'm saying is that, well, bonds up and down and everything that I've pointed out here, all it is doing, it is making this blue curve here wider. That's it. When these interest rates start moving around, as up here, and you can see this is the shape of the curve with some have to do with the forward rates. When this starts moving around, equity doesn't like it. They don't like volatility down here on the R. They don't. And now you can see what looked like different topics of this, that, and the other, even within finance, are closely linked and need to be understood in the proper order. Right? Don't add and subtract before dividing and multiplying. The bond market is the far bigger market, and foreign exchange dwarfs it. From there, if you can see through the lens, and then you can then go on to your other narratives of, oh, well, this company is going to change the world. You can have at it, and you can maybe right within some time period. But you need the support of this overall structure. And this has explained why equity is higher, right? We have had coordinated, not only central bank movement, coordinated global central bank movement to push R down in unison. We don't have that, and that's the issue. We do not have that right now. And the debates, international debates, the international, discord, and I'm not talking about Discord, the technology platform. I'm talking about the discourse, which means trade war, etc., etc. That what it can do is it can people will have the debate about their foreign currency, and that will ripple into R, which then ripples into stocks, and it's much bigger than the size of Jay's Rib Shack or some small cap. Jay's Rib Shack doesn't register on the radar. Okay. I didn't say that all of this was going to be absolutely bad. No, I did not. Which is that while this is the question that I've just discussed. We're going to end this by having this very important thing, which has to do with retirees can be helped here. That is possible. And this means people anywhere close to trying to think about retirement. that if another way of looking at this, one of the ripple effects is that interest rates higher, better alternatives. And where I'm going here is if you look at this timeline, something I've discussed, you can see that I've highlighted from when I had a production problem, that in red here, what I've stated here is these numbers here will look much better. Much better. The level of interest rates is the minestrone soup to everything here, including the returns on the cash value in universal life insurance, including the guaranteed rates of return that are guaranteed by insurance companies in the form of annuities. The reason this is important, right, is discussed here in, as I stated at the beginning of the video, which is higher interest rates can help your plan. And I'll show that to you now. I hope. Yes. And there it is. So this, as I said, that what I did is I explained the three-legged stool in the past to people. You know, there's this idea of three-legged stool. And I now said, look, as a result of changing interest rate there from Tina, there is no alternative to there are alternatives. In other words, the things that I've discussed here, the things that I've discussed, the things that I've discussed in here, the other way of is that the insurance company is the borrower of money, your money, right? You're giving 100 units, they're in effect borrowing. They're going to give it back to you in some format, some form of cash flow. Follow the cash flow. The rate at which they are required to do so is higher. Why? Because interest rates are higher. The cost of borrowing is higher. This, therefore, is like the soup base, beef stock. Do you make minestrone soup out of beef stock? I don't even know. I wouldn't make it from scratch. So anyway, here we go. So my point here is that you've got beef stock, which is higher paying here now in these line items, in these two lines, which is in red. And the reason that matters is because of the fact that this is telling you, and this is the three-legged stool that, this is the higher interest rates can help your plan paper, which sits in the subscriber version of Jay's Corner, which is to discuss about, for example, the impact pension funds, valuations, and the value of higher yield. And now you can see it. That this then is, while equities may bounce around more violently as a result of uncertainty and A, higher in absolute terms, B, more uncertainty as a result of all of the dynamics that are going on, right here, that on the flip side, for those of you who have higher balances now, which is almost everyone, unless you really didn't sat in cash and didn't put it in a money market mutual fund, your balance is higher today. And what I'm saying is that while it looks unsettling on headlines, and I suspect that it will be for the immediate future, we have an inauguration, we have earnings, we have inflation statistics. This is not investment advice. Do your own research. That those the number one most important factor is set up to reasonably be uncertain, right? In other words, while we don't have a crystal ball, everything here is telling you something uncertain. The market price movement is telling you this. You don't have to have a crystal ball. You do have to be an observant of the facts as given to you if you want to understand how all of these pieces fit. And you are affected. The, and that's my point here, right? Which is that, look, we have a we don't have a three-legged stool anymore, right? Because most people do not have we do not have this employer provided pension portion. So as a result, you have a two-legged stool: Social Security, personal savings, and investments. It's incredible what AI did. They took the slide and they converted it into this text. And I read all of them and I was like, well, the reality is I sent it. It's crazy. I sent it. Please write in the style in which sound and look like Jay, and here are examples. And I sent it Maximize Your Medicare and it studied it. It's like, that's how I trained it. Crazy. Oh no, AI, that's a flash in the pan. Okay. So what you have here is that what it has done is, while it has maybe hurt here, number three, it has allowed for these other instruments to basically replace number two. And that's what I am trying to get at here. Right? That's what I'm trying to get at, that because of the fact that by numeric function, right? I don't care about amounts. I'm like, what can I turn into cash after I pay for taxes so that I can use it? Whether that be for groceries, whether that be for stuff I'm not supposed to be using money on, right? I want to know what's the cash after taxes under these scenarios. And my point here is that because of higher interest rate, the numbers that are going to be showing up here in these red rows here is higher. And now then has this function of, notably has this function of here, which is to take the place of what is now eroding from the landscape, which is point number two, right? You know, we've got 401ks. We don't have defined benefit pensions. In fact, one of the points that Boeing was trying to strike about was to try to return back to number two, because they realize, and that's the engineers, right? So you're not talking about the dumb guys in the room, absolutely not, right? That they're numerically superior to average, no question. That, I hope so, that they want to return to this. Why? Because they realize that, oh, you want me to drive this? That's a lot harder than people thought. Which is not a surprise to me. No, not. Like I said, people haven't understood the other videos that I've talked about how the efficient frontier works, how that linear algebra, you know, how a diversified portfolio is actually built. So the smart guys in the room who don't necessarily, but they are educated enough in science and math, they didn't need to know and calculate. They could just see it. And then they're seeing it and going, you know, what I thought this exercise was isn't what this exercise is at all. I read up on Forbes and I read up in Fortune, and no one told me about correlation and covariance. No, that doesn't sell magazines. I wouldn't want to buy the magazine. Well, I would, but So here is this, is that the higher interest rates, then you can see what the point and why I'm so excited about having these available for you, right? Which is that these documents now can kind of help guide you so that you understand what they look like compared to having like and this is the high end. This is the high end of explanations. This isn't, the Uber driver's explanation of the bond market. This is the high end, but still the consumer and incomplete. Okay, that's a very good place to stop. It basically is telling you, and I'll stop it here with the following takeaways. Please be sure to like and subscribe to the channel. Thank you. Jay's Corner is jo.substack.com. You can see it there below my talking head, there on the left side of your screen. There's a free and the paid version. The paid version, as I stated, we are going to continue to populate this. I'm committed to this, meaning that I'm going to continue to go across. And some of it's going to be basic and some of it's going to be esoteric. I understand that. But I'm also sure that just understanding even a single document can make a very large difference to your understanding and your sense of understanding about how to separate the signal from the massive amount of noise that you get hit with. I encourage people, given everything that I've said here today, I highly encourage people to not fall asleep at the wheel. Because of this, because of the way that sequence risk works, sequence risk can also now go in your favor, right? Which it has done 20% on S&P 500. Your strictly diversified portfolios would not have done that, right? But you can see my point. Over the last 2 years, certainly higher. Certainly higher. And with interest rates higher due to the noise that we see or the information that I've pointed out here in today's video, that the conclusion is that there would be opportunities for those people who are paying attention. And that should be yourself. Absolutely. Whether you be a planning person, this is good all the way down to like 40s. If you're in the 30s, you may just change your pie. That's true. But anywhere else, and from there, because the value of these contracts depends on the rate and the amount of time that the money sits in these structures. The amount of these are affected by time. It's not only interest rates, but the amount of time that the money, I tell clients, describe as it depends on the amount of time that the money sits in the coffee can. You've stored it here. It needs to grow. How does it grow? It grows because of interest rates at higher levels. That means there's compounding. And that's the power of it. Okay. By all means, this means you should put your hand up. info@gh2benefits.com to see whether or not you... And this also is true for people with existing setups. Maybe you've already known everything. You're already in here in some format. If that's the case, it's still a good time to take a look to see whether or not you're getting the most out of what you currently have, so that you can make sure that you have the stability down here on total net worth, which is ultimately the answer that we are all seeking. All right. Thanks very much for watching.